Traders on high alert as signals hint the U.S. could step in to support Japan on the yen. A rare rate check by the New York Fed and a sharp warning from the Japanese Prime Minister have fueled speculation. We break down what this could mean for global markets. Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, gold is above $5,000 an ounce, first time ever, extending a rally fueled by President Trump's reshaping of international relations and investor flight from sovereign bonds and currencies. PineBridge Investments co-head for Asian fixed income joins us with more on how investors are viewing the risks and opportunities in the bond market. President Xi Jinping's move to investigate his top general is the most stunning development yet in China's biggest military purge in roughly half a century. National security specialist and former CIA official Dennis Wilder joins us on how he views the turmoil in the PLA caused by Xi's corruption cleanup. And live from the Asian Financial Forum, we'll be hearing from the World Gold Council CEO David Tate and Blackstone Private Wealth's APAC head Ed Huang. Let's focus in on markets today. The dollar's slump to its lowest level since September is pushing U.S. stock futures lower. Gold is above $5,000 for the first time, and of course we're watching gains on the yen. This is on speculation that the U.S. might assist Japan in efforts to boost the currency after a rate check on Friday by the New York Fed. The yen is on intervention watch after Japanese Prime Minister Sanae Takaichi warned the government is ready to take action. To walk us through the market moves, let's get to MLIV Executive Editor Mark Cudmore in Singapore. So, Mark, this rate check from the New York Fed, give us a sense of how significant this is from an historical perspective.
So the MOF sometimes has used the Fed in the past for its rate checks. I believe the last time was after the Fukushima disaster in the earthquake in 2011. It is generally rare that it does so. It's not unprecedented, but it is rare. What is even probably more rare is the fact that the Federal Reserve Board of New York made very clear that they wanted this rate check to be very public. And that's got traders speculating. I think speculating is the really key word here. We have no concrete evidence of whether this was the Federal Reserve Board acting on behalf of the MOF, which they have done before, even though it's rare, or whether this was the US acting unilaterally, kind of leading and informing Japan afterwards, or whether this is a hint of coordinated action. And so I really want to emphasize that, which of those options is very much speculation at the moment. But there's certainly been a warning sign sent by officials that if the yen continues to weaken significantly, that physical intervention is a risk. They may not need to do so. The dollar was much weaker last week. It's weakening again this week. And it's not just the yen story that's helping that. We've seen that with dollar yuan breaking below 7. But we've generally got this theme out there of quiet quitting of US assets. People looking to diversify away from the US dollar, and that is the broader trend out there. So the dollar-yen story is just part of that. In fact, it's actually more about a dollar story than a yen story, and that's why we're seeing such extraordinary moves in some physical assets like precious metals.
Yeah, let's talk about the dollar side of the equation first. But, sticking with this rate check from the Fed, you say they may not need to take action. But, how's the market going to react if there is no follow-through? And what possible action could they take, and how enduring might that be?
So I think if dollar-yen goes back higher and they don't intervene, that would be problematic. But if dollar-yen might now continue lower on its own, you've got to remember this was a market that was short yen last week, and so they've been caught wrong-sided by this. And it's also at a time when, as I said, there are broader conducive reasons for a dollar depreciation trend to intensify and to accelerate. So the fundamental picture for dollar-yen weakness was already turning, and now it's been given a push. And the way that this may happen from officials, and again, I emphasize that speculation what the moves are, is that they may intervene only if dollar yen bounces back up, but we might not see that bounce significantly. We're going to have increasingly technical damage in the dollar yen market on the downside, and I think this market could build its own downward momentum without even physical intervention.
So let's get back to that other point you made about this potentially being a dollar weakness story as well. Why are investors fleeing the US dollar at the moment?
There's a country with a current account deficit, large debt pile. It's a very expensive currency, and the world is massively overexposed to the dollar. Now, there are not viable alternatives. The de-dollarization trend is real. It's important to understand the context of this. It is going to remain the world's reserve currency for a long time to come. There's no real other viable alternative in the fiat space, and if it stops being the world's reserve currency, we've got a much bigger problem on our hands. But people just want to diversify further away from the dollar, and that's been an ongoing trend for years, and it's going to accelerate now because the policy uncertainty out of the US is getting reminded on a regular basis. You know, the latest was this weekend that we saw a threat of 100% tariffs on Canada, and it's emphasizing that it's too risky to have too much economic interdependence with the US, and therefore people need to diversify. So they need to diversify on trade, they need to diversify on business, and they basically need to diversify their exposure. So many countries in the past, because the dollar smile, this idea that if US stocks sold off aggressively, well, the dollar would benefit as a haven asset. They therefore had low FX hedging ratios. What that meant is, if you take where you're from, Paul, Australian supernationals have the superannuation funds, have some of the lowest FX hedging ratios in the world, and that meant when they bought US stocks, when they invested in US stocks, they didn't bother hedging the currency exposure. But now suddenly that dollar smile might get broken as the US dollar gets undermined, and it becomes a self-reinforcing spiral. So they're going to increase FX hedging ratios, and there'll be more pressure to increase hedging ratios the more that Aussie dollar climbs against the US dollar. So that's just an example from your home state, but that is a global dynamic out there. So on top of this whole dynamic about increasing hedging ratios and the quiet quitting of US assets, we're heading towards, it looks like, another US government partial shutdown. And that shows that this is an economy that's got domestic problems and geopolitical problems.
Yeah, and you mentioned gold, one of the obvious beneficiaries of this trade at the moment. How much more upside can we see to the gold prices? It's cracked $5,000 now.
I think gold is more sustainable than what's happening in silver, but certainly precious metals overall as a group have just been going absolutely bonkers. The word bonkers doesn't seem very professional or appropriate market setting, but it is appropriate here. What we've seen in silver, for example, is that it's done 110% in the last 2 months. It's 55% year to date. We're only in January. I think it's up about 13% or more since Friday morning. I mean, these are just really extraordinary moves. And what that shows is that we're starting to lose two-way liquidity, which means that we're kind of getting, it feels to me like we're getting towards the frothy end game. Now, that's particularly dangerous when you're in a kind of bubble market, and there's a fundamental driver for it. As I said, people are looking for real assets away from fiat currencies and away from the dollar in particular, but it does feel this is vulnerable. What would cause it to pull back? And you asked about gold, but I think it's all the same trade here. It's just that silver is the higher beta version. If we get some severe risk aversion, then people will be forced to deleverage. They'll be forced to take profits on some of their winners, and people who got in late to this trade will be selling out. So I think if we see severe risk aversion in stocks, you could see a very painful pullback in these precious metals, even if the fundamental trend's very valid and even if they rally again afterwards. But the pullback, given the scale of moves, the pullback could be extraordinary in the short term if risk aversion increases.
All right, MLIV Executive Editor Mark Cudmore there. Let's get some more on this with Omar Slim, co-head of Asia Fixed Income at PineBridge Investments. Omar, thanks so much for joining us today. And I just want to pick up on those themes that Mark was talking about, illustrated by a chart we see here with the US dollar hitting multi-year lows now. To your mind, I mean, there are a lot of factors driving this. What are the main ones? What's the top of the menu for you?
Well, I think at the risk of repeating what was said before, I think the U.S. assets were very well owned, particularly when it comes to the equity side, but including the bond market. So I think there is some profit taking, or at least some diversification that's happening, and that started last year. I think policy risk is front of mind, quite frankly. There has been a lot of policy twists and turns, and I think the market is taking those much more seriously now. So I do think that there is some desire for diversification. I think there has been some diversification away from some U.S. assets. But again, I think that trade has its limits, if only because of the sheer size of the U.S. markets, which are not replaceable, quite frankly.
I want to discuss the US side of the equation a little bit more later, but let's start with some of the price action that we've seen in the yen, which has, of course, strengthened something like 1% since the close on Friday. This is merely on a price check from the New York Fed. Again, how unusual is this, and do authorities now need to follow through here?
I think that's a very good question. So first, it is quite unusual, particularly when there seems to be some coordination or some speculation that there is coordination, particularly with the New York Fed getting involved. So yes, it is quite unusual. I think the last time it happened was right after the Tohoku earthquake in 2011. And before that, it was a globally coordinated action with GFC and so on. So yes, it is quite unusual. I think the fact that this is quite rare can push market action even further, and it can square some positions and so on. But to your point, even with that kind of coordinated action, I think the market can test, again, the authorities. And then there could be some need for some actual intervention. And my own view on intervention is, however big it is and however coordinated it is, if the fundamentals are not there, the market will move in a certain direction.
Well, we've got a 40-year bond auction this week for JGBs, which is interesting timing. What are you expecting in terms of demand as we see the yen firming?
I think the JGB story is probably one of the most interesting stories that we have seen, particularly last year. Quite frankly, we talked a lot about volatility last year, but where we actually saw a lot of volatility was particularly in the longer end JGB. And I think here it's a pretty multi-layered story. I think there has been a bit of a structural change in terms of the ownership of the longer end JGB in particular. I think there has been a bit of a regime change in Japan, particularly when it comes to the inflation inflection point, which led to the Bank of Japan changing course. And quite frankly, there has been a lot of more foreign involvement. So I think some auctions will go well, some will not go well, but I don't think that the long end JGB is well anchored. I think that story has some room to go and could be subject to more volatility, certainly much more volatility than we've seen in the JGB curve over the past few years. So I expect that the fact that every time that there's an auction, folks are talking about it, is essentially a sign that there is some nervousness around it. And I think that could lead to more volatility on the long end JGB.
Yes, so possibly more volatility. Do you think it could be on the scale of what we saw last week, or could it potentially be larger?
It could be smaller, it could be larger, it could find a footing. It really depends, in my view, in terms of the announcements on the fiscal side and the election results in Japan. So I think that will be a key determinant in terms of the long end JGB finding its footing. There's no really easy answers, quite frankly, there. And the fiscal space that Japan has always been quite tight. As a matter of fact, the fiscal metrics in Japan have generally been improving, and yet you see more volatility. And I think the reason for that is just a kind of heightened sensitivity when it comes to fiscal globally, particularly for Japan. But more importantly, the fact that there has been a regime change in Japan and more foreign ownership. So it will depend in terms of the fiscal announcements out of Japan, which I think should continue to be more kind of going towards fiscal largesse, which causes me to believe that we can see more volatility there.
Yeah, certainly a reasonable expectation based on what polling suggests around the upcoming election on February 8. But just in terms of those yields rising on the longer end, particularly for JGBs, what pressure do you see this putting on rates globally?
It does put pressure on rates globally. As a matter of fact, yes, last year in the kind of spring of 2025 or early spring 2025, it all started with the JGB, quite frankly. And this year, what happened last week is another testament to that. So the short answer is yes, it will put some pressure on the long end globally. I would even say that it will put pressure particularly on the treasuries because of the fact that there are some fiscal concerns there as well. And there is kind of a historical correlation in terms of these two markets.
Do you anticipate any action from the BOJ to get the yield curve under control?
Well, they could job on it. They can essentially talk about it, but they have a plan to reduce the size of their balance sheet. And kind of U-turning around that would be detrimental to their credibility. So while they can tweak here and there and they can do certain things, I think they're either serious about what they said about the balance sheet reduction or not. And I think that they can do certain things in times of emergency. They qualified their statements and then they said that they can intervene. But again, intervention can only lead to so much. And I think generally the Bank of Japan would like the market to kind of do its own thing at this point.
All right, Omar Slim of PineBridge Investments is sticking around. When we come back, we're going to take a closer look at U.S. Treasuries ahead of course, this week's Fed rate decision. This is Bloomberg. Welcome back. You're watching Insight. Coming up this week, the Fed is expected to keep interest rates unchanged amid global economic uncertainty. Traders will be watching for clues about how long this pause will last and whether FOMC participants will unite behind Chair Jerome Powell. Peers in Brazil, Canada and Sweden also likely to hold rates steady. Singapore is also set to keep its policy settings steady. Bloomberg Economics notes that growth picked up last year despite trade concerns, signalling current policy should be able to counter a moderate slowdown in demand. Elsewhere in the region, Pakistan's central bank is expected to hold rates following December's surprise cut, and Sri Lanka also likely to stand pat after an extended easing cycle, with inflation rising and domestic demand firming. Well, Omar Slim, co-head of Asia Fixed Income at PineBridge Investments, is still with us. And Omar, I want to pick up on the Fed rate decision this week. No change as expected, but as we were discussing a few moments ago with the rather febrile environment around what's happening in Japanese bonds and US politics as well, do you see things getting a bit more complicated for the Fed going forward?
Well, I think for the Fed, yes, the short answer, it is more complicated because the environment is more complicated in the sense that we still have some inflation. In my view, we could have a bit more inflation. There is a fiscal impulse that's coming. And of course, there is a change in terms of the Fed leadership that is expected towards the end of the second quarter, which I think will be extremely important. I think when it comes to the Fed, for now, I think what the market will be watching is how the committee is essentially how cohesive it is and how coherent the messaging is in terms of the Fed speak. We have started to see kind of little bit of factioning here and there, and I think that's what's to be expected. So I think the market will be watching for that this week.
What's the greater force that the Fed needs to be aware of in your view? Is it the stickiness of inflation or warning signs from the jobs market?
I think the way the Fed typically looks at it or should look at it is they will focus on whatever the metric that is further away from their target, meaning if the job market is seeing substantial weakness, they will focus on that. If the inflation is quite a bit away from their target, then they will focus a little bit on that. Both of them are quite a bit away from their target, then I think that becomes an issue. My view at this point is that the job market has seen some weakness, but it is more segmental in the sense that there are some segments that are weak, others that are not. Inflation is still above target, and in my view, can go higher. So in my view, the Fed would probably be focusing on inflation as well as the overall job market.
Well, you mentioned a moment ago that we will get a new Fed chair within a few months. Do you think that's really going to mean lower rates, though? Because I do wonder how the bond market might react if suddenly monetary policy is being set for political reasons rather than data dependency.
Yeah, I think this is a very, very important question. And I think that's what I meant when I said earlier in terms of policy risk. To me, it's not about the type of, in terms of hawkishness or not hawkishness of the appointee. it would be more of how credible that person is. Because I think generally what we have seen previously with Fed chairs is that they tend to be they tend to have a certain kind of color before they are appointed, but then they become very data dependent as they should. So I think to me what's important is whether it's a credible candidate or not, as opposed to what their inclination is, because you never really know how things will happen after they become Fed chairs.
Do you feel there's a possibility that this year we could see no easing at all from the Fed? And how might the president react to that?
Yes, I think that there is a real possibility that this happens. Obviously, that would be against what we've heard from the president and his wishes. But I think from a kind of just looking at it from a pure data perspective, if we do see an acceleration in terms of inflation, which again I see as a real possibility, and if the job market is kind of still relatively strong, there are certain segments that are weak, others that are quite strong, but generally relatively strong, I think there is a real possibility that the Fed does not move. And I would say that the consensus right now is relatively weak, and I would say quite fickle. It can change quite quickly.
At the start of this conversation, I did mention the U.S. domestic environment as well, which has become somewhat tense over the weekend. We now have the potential for a government shutdown in about 4 or 5 days' time. Is that on your radar? How likely do you think that would happen, and how would you position in advance of that?
In terms of the policy risk in the U.S., there's different levels of policy risk, quite frankly, and the market has been getting used to certain types of policy risk and, quite frankly, desensitized to some policy risk as well. In terms of government shutdowns, the market, when it happened last time, the market reaction was relatively benign. When it was getting very prolonged, the market started to take notice. So the short answer to your question, if it happens and it's one of those government shutdowns, perhaps the market is going to ignore for some time. But it just adds to kind of the general policy risks that we're seeing from the U.S. and elsewhere as well, but certainly from the U.S. And it depends on what kind of policy risk. I would say that, in terms of appointing the Fed chair, that would rank quite a bit higher in terms of the market psyche.
All right, Omar Slim, PineBridge Investments, thanks so much for joining us today with your analysis. Still to come, China launches an investigation into its top general, marking its biggest military purge since Mao. The initiative for U.S.-China dialogue on global issues will be with us to look at what this means for President Xi. That conversation up next. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand as mainland China heads to lunch and Japanese markets come back online. And Japan is the focus of a lot of what we're talking about today. We're seeing a lot of weakness for the Nikkei, off by nearly 2%, perhaps unsurprising considering the big moves that we've seen in the yen. Lost a lot of ground since Friday afternoon. We're now at 154.22. This is after the New York Fed was asked to conduct a price check, which suggested possible coordinated intervention from both Japan and the United States to prevent the currency from weakening further, and message received. Let's see how long it lasts. Elsewhere, we've got yields in Japan settling down with the 10-year there, 2.231. We heard from Goldman a little bit earlier saying that JGB yields are too high and the 10-year should be at 2%, so a little bit of room to move there as well. Gold, meanwhile, down the bottom in the middle of the screen, yes, it cracked through that $5,000 an ounce level and is showing no sign of slowing down. In other news, China's top general is reportedly accused of passing secret information about the country's nuclear weapons program to the United States. According to the Wall Street Journal, Zhang Yuxia is also accused of accepting bribes for official acts, including promoting an officer to the post of defense minister. The report goes beyond China's announcement on Saturday that it was merely investigating Zhang. Our next guest is a former senior U.S. intelligence official and served as the National Security Council's director for China and then as its special assistant to the president and senior director for East Asian Affairs. So let's get to Dennis Wilder, senior fellow now at the Initiative for U.S.-China Dialogue on Global Issues. Dennis, thanks so much for joining us today. I just wonder if you could start by telling us the significance of what we've seen happen in this latest step of the purge of China's military.
Absolutely, Paul. This is a stunning development. It is the biggest development in Chinese politics since Xi Jinping came to power and had, as we know, 3 terms of government. It's a question of sustainability of the Xi Jinping regime, whether or not he really can serve for life. Zhang Youxia, the man he has purged now, is the top general in the PLA. He's a war hero from the Vietnam front in the early 1980s. He is the most respected PLA officer with a huge network within the military. He's also the son of one of the founders of China. He is a red princeling, as they are called, with equal stature, frankly, within the party in many ways to Xi Jinping. So it may be that as he accumulated power in the military, and he did get rid of one of his opponents in the military, the first vice chairman, He Dong, recently, it may be that Xi Jinping thought he was part of a cabal who would try and keep Xi Jinping from a 4th term in 2027.
So do you think that is what is at the core of his investigation and his removal? Or could it be that these charges have some credibility? Or which is it?
The charge of working for the CIA or leaking the secrets of China's intercontinental ballistic missile force is an old one. It came up in 2021 against the former defense minister. This is not credible. It may be used by Xi Jinping to bring down his opponent, but Xi Jinping has a paranoid personality. He thinks the CIA, Black Hand, is out to get China. He thinks the CIA is behind Hong Kong unrest, the Uyghur unrest, Tibetan unrest, the Tiananmen Square democracy movement. So it's not unusual for Xi Jinping to have these suspicions of the CIA, but I would take this one with a real grain of salt. It has the feel, if it's true, of Xi Jinping kind of throwing everything but the kitchen sink at Zhang Youxia.
Is there a risk here as well? I mean, on the one hand, you point to the possibility that Xi Jinping is doing this to shore up his own power. But then on the other hand, by removing the old guard, by removing a lot of allies, is he perhaps exposing himself?
I think that all of these purges really do hurt Xi Jinping within the party. I hear from many party members that they're uncomfortable with the power of Xi Jinping, and they're uncomfortable with his mercurial ways. He has not only purged in the military, but huge purges in with the party, businessmen. I think for many, even in the party, this has gone too far. I think that there are real questions about whether the party wants him to stay after 2027. So yes, I think there's a bit of instability here. And I think we've been too comfortable thinking that Xi Jinping is in total control of his future.
How would these changes impact the PLA's operational readiness? Because we've seen dozens of generals and other even higher-ranking officials being removed.
Absolutely, Paul. There is no question that leadership decision-making in the PLA will be affected for a long time. First of all, Xi Jinping will have to pick a whole group of successors. And it's difficult because remember that Zhang Youxia's reach within the military is huge. He's been in the military since 1980. He has a huge set of subordinates who have been loyal to him. Now, I will tell you, unfortunately, what they're going to do is they're going to sweat Zhang Youxia. They're going to get all the information they can out of him on who his subordinates are, who they find is guilty of working with him. This will take time. Xi Jinping has to replace virtually the entire Central Military Commission. It's as if in America, the whole Joint Chiefs of Staff, except one general, was replaced. So military leadership, military morale will suffer. Will the units on the Taiwan Strait still be good units? Of course. They're well trained. The Air Force knows what it's doing. The Navy knows what it's doing. But in terms of whether or not Xi Jinping would take any coercive action against Taiwan anywhere in the near future, my betting money is we're a long way from that.
So if, as you say, Zhang would now be taken away to be sweated, to be found out who his allies and supporters are, does that suggest there's more to come, that this purge isn't finished yet? And what other military leaders in China should be looking over their shoulder right now?
Well, every one of the theater military commanders would be suspected. Anybody who served with him during the time he came up, whether it's in the equipment department of the PLA or in field units of the PLA, his whole entire network. By the way, this goes beyond the network. It goes to his family, it goes to his friends, it goes to his children. When these kind of purges take place of an individual in China, it is devastating, not only to him, but to his entire family. Everybody loses. And this is very common in the Chinese system today. You are taken away and you are told, if you don't confess everything, you get an execution sentence. If you confess everything, we will give you a life sentence. And this has happened over and over again in the Xi Jinping era.
You mentioned the paranoia of Xi Jinping around activity from the CIA in China. To some degree, does this destabilization of the military fulfill the CIA's aims?
Well, I can't say that it doesn't. There would be the hope in the CIA that others who are scared of what might happen to them might come forward to offer their services to the United States. I think you know that the CIA has a program right now where they are using social media to reach out to Chinese. It may be that some officers within the PLA will see this as the opportunity to get out of the system and defect or offer their services.
Are there some other implications here as well for regional security? I mean, you mentioned readiness around the Taiwan Strait, but of course there is tension elsewhere in the region with China and its near neighbors, various overlapping maritime claims as well. But also there is frequent military-to-military contact between countries. Could this be impacted in any way?
Well, I think one place I would worry about is the South China Sea. I think in order to prove that he has still military readiness, we could see Xi Jinping taking a tougher stance, for example, with the Philippines over the disputed islands and reefs in that area, perhaps with the Vietnamese. In other words, smaller targets. I think he will also be very sensitive, he already is, to Japanese, what they are calling Japanese militarization. So I would expect Xi Jinping, to some extent, to try and show strength. It'll be interesting. I understand the British Prime Minister will land in Beijing fairly soon this week. It'll be interesting to see how Xi Jinping takes that visit. Will he want to make some arrangements with the British, for example, that might go beyond what he might want to do before this? What about the visit in April of Trump? Will he see the need to shore up the U.S. relationship? It is very early in this process. I can't answer those questions, but I think people should be thinking about them.
Yeah, let's talk about the U.S. side of this equation just before we wrap things up. Are you at all concerned about how the U.S. has been alienating many of its close allies recently, and to what degree does that further China's aims?
I'm very concerned about that. I think that the United States has the allies as the best defense against China in the region. China has no allies in the region other than North Korea. We have, over the years, and I participated in this, worked very hard to build relationships with the South Koreans, the Japanese, the Philippines, Australia, Singapore, and others. And I fear that the way that Trump, frankly, callously diminishes these relationships is a real problem. I think it will do lasting damage. I only hope that we can recover from this with our allies. But certainly, if I'm an ally in East Asia, I'm wondering about the staying power of the United States and whether indeed the United States will pull back a bit to its own hemisphere.
All right, Dennis Wilder, Senior Fellow at the Initiative for U.S.-China Dialogue on Global Issues. Thanks so much for joining us with your insight today. All right, we're getting a few lines from Japan's Finance Minister Satsuki Katayama. Surprise, surprise, talking about the yen, saying we are watching Forex moves with a sense of urgency. These are some remarks made by the Finance Minister a very short time ago, about 10 minutes ago, in Tokyo, saying we will respond to foreign exchange in accordance with the U.S. Japan Accord. So in many respects, supporting what the market suspects here following the New York Fed's check of the currency. That the US and Japan prepared to act in concert to defend the yen. So the yen holding on to those gains, 154.20 at the moment. Still to come, Hong Kong aims to become a major hub for gold trading. Live from the Asian Financial Forum, we'll speak with the World Gold Council's David Tate on what it takes to achieve this, as well as the red-hot rally in the precious metal. This is Bloomberg. Welcome back. You're watching Insights. Well, it's bright, it's shiny, and everybody loves it at the moment. It's gold. It's above $5,000 an ounce. It's doubled in price in 2 years. The superlatives just abound, continuing to gain aggressively today on the back of dollar debasement, instability, and, pick a factor, basically. Silver's rally even more impressive, now above $108 an ounce. Let's get more insight on the rally in precious metals. The China Show anchors David Ingles and Yvonne Mann standing by with our next guest at the Asian Financial Forum in Hong Kong.
Yeah, Paul, everybody's an understatement. It's everybody, their mother, their dentist, their ex, pick your derivative as far as...
Go melt your watches now.
Go melt your watches now. We've seen the lines. We've also seen, you mentioned 5,000, right? We've seen Wall Street, I think, revise their forecast every couple of weeks, right? So it goes to show really how what's the price we attach to that right now, and how we sort of catch up to this really this rally that's melted up quite substantially. Well, joining us here in set might be someone who probably has some insights along those lines. David Tate joins us right now, CEO of the World Gold Council. David, thank you for joining us today. Let's say it's quite an opportune time to be having. Why don't we start there? What is a projection worth these days in terms of the gold? What is your projection?
It's easy to answer it by saying I think there are still 6 or 7 good reasons why gold will continue to go higher. And one possible outcome, albeit low probability, where gold could either top or go lower. The reasons why it will continue to go higher, you will always hear about the geopolitical situation. Yeah, that's sort of a bit boring in many respects because the market discounts things extremely quickly. So these tariffs things, these wars, even wars come and go, not to diminish them in any way. They're relatively minor drivers. The main driver has been over the last 3 years central bank buying. But remember, they're buying it not just for geopolitical reasons, but for own wealth management. Their own portfolio adjustments need to be made. These central banks, think of their portfolios in the same way. They have vulnerable currencies. They see inflation. They need to offset it. They're comparing themselves to their Western counterparts. So I think that will continue. Then you've got the classic macroeconomic story, which I know many traders around the world stare at, based on the dollar and based on the interest rate scenario. But there are a number of things that are not being considered. One is deregulation in China. For instance, their insurance market at the beginning of this year allowed their insurance companies to invest in gold for the very first time. That's a $5 trillion market. They allowed 10 insurance companies to invest 1% to begin with, which is a huge amount of money. Secondly, in Japan, you've got a whole generation passing a huge amount of money from old to young. Then they're experiencing inflation for the very first time, geopolitical problems, a nationalistic prime minister who actually wants to spend and spend and spend. And that will get me to my third point in a minute. So a lot of people willing to accept gold and gold ETFs in Japan. And then India, a whole new generation who perhaps won't want to hold gold as jewelry in the future. I'm not saying jewelry will come down, but alternative forms of financial instruments. They're far more educated, they've got electronic access. And so a lot of people in India who will be buying gold as well in new forms. But the most important thing that's been driving gold has been the fear of runaway debt. And I still think that is the case. Last April, we reached a situation when the tariffs were introduced and the whole yield curve shifted in one go. And Mr. Besant stepped in to intervene.
It almost seems too good to be true, though. I mean, I'm just trying to be the devil's advocate here. Is there any, at one point, we're already at 5,000. Is there a level that you see that it's going to start pricing out buyers and investors?
I think you're already seeing some jewelry people being priced out by definition. But as investors, people tend to chase rallies. So the central banks will not chase it. They will probably sit underneath waiting for retracements. But they're going to be there, as I've described. The one thing I think that could tip the balance against gold going forward is if Mr. Trump, who apparently is the luckiest human being ever to walk this earth, in my opinion, actually manages to pull off a couple of things. He's obviously pushing for very high levels of growth by forcing interest rates down. You know the Fed situation very well. And you also, I perceive them to be willing to accept relatively high levels of inflation. If they manage to produce those two things, pay down the current account and project long-term debt as having peaked, that is where I think many of the people who have been claiming debasement of currencies will have the story slightly robbed because it's an unexpected outcome.
Right.
And that's what I think they're trying to do in the United States, and that could mark the top of the gold mine. But probability adjusted, low probability.
What about, you mentioned one of the main drivers, if not the main driver, has been central bank buying. And I wonder what degree of confidence we can attach to continue buying at the current pace, for example. And, is there any leading indicator apart from the fact that they report what they bought?
No, there isn't a leading indicator, but we know for the last 3 years there was 1,000 tons, and this year is just under 1,000 tons, with Poland this year being the predominant bank. Many of the banks do not report their numbers, and so we have to glean it from our relationships and stuff. But I don't see any reason. What they are not prone to do is pay market prices. What they are prone to do is sit on the bid, to coin a phrase, and let it come to them. But they are all still buying. There was only one or two central banks, frankly I can't remember which ones, who sold a little bit last year. But do remember that they manage their reserves the same way you manage your own portfolios. And they are trying to learn from the Western central banks, I believe, because they have historically had currencies that fluctuate wildly, have spikes in inflation, are not as secure. They're emerging economies, and they believe that they need to hold greater reserves. So everything points to them mimicking to some degree the Western central banks.
And you're seeing why Hong Kong perhaps wants to develop this sort of global trading hub here. London, though, it's been the traditional hub, and it's very entrenched. What do you see needs to happen for Hong Kong to really kind of compete in terms of liquidity and the like to be a global gold trading hub?
Transparency more than anything. I think that's the important thing, and you have it in droves. I have no doubt that Hong Kong will establish itself in the region as the predominant gold centre. Many things have to happen. You've got the refining capacity, you've got the willingness to set up the exchange, you've got a number of central banks who will no doubt want to custody their gold in the region. You have everything going for you. The one thing, and I would be at pains to mention this in my piece this afternoon, is it must become with responsible sourcing. It must come with an acknowledgement that the gold must be secured from regions and from mining communities that are up to muster, that pass this test. Because bad stuff in, is bad stuff out. And that is not a smart situation to be. There's no suggestion that they will not do that, because I know that LBMA refineries are very much engaged in the equation, but I would warn the authorities that that is probably one of the most important things to gain international acceptance.
Digital gold, tokenized gold, how should I look at that and how it's going to shape this business?
It's an interesting question. We have been running studies recently as to why the big gold stable coins in the world, for instance Paxos and Tether, why they have been relatively, in fact very unsuccessful. They won't mind me saying that. Roughly $2 billion under assets each, over a period where gold has gone up 5 times. So there's fundamental flaws in the concept, and we're not really sure why. It could be the cost of them, lack of trust, lack of regulation. We're waiting to see. Will the Hong Kong authorities launch gold stablecoins? I'm sure they will try. The question is there a market for them? Do they do anything but provide a more expensive alternative to gold ETFs, which are predominant at the moment? Remains to be seen.
David, we'll await, of course, your talk this afternoon. Thank you for spending time with us. You're a busy man these days, we understand. David,
thank you very much.
David Tate there, guys, out of the World Gold Council. He's the CEO. Paul, back to you.
All right, thanks, guys. That's the China Show co-anchors David and Glaze and Yvonne Mann there with the Gold Council CEO. Take a quick look at Asia FX. We've got the yen holding on to gains, 154.22 at the moment. This is after the New York Fed called a price check on the yen, which suggests possible coordinated U.S. Japan action to defend it. More ahead in the next hour. Our coverage from the Asian Financial Forum continues. This is Bloomberg. Welcome back. You're watching Insights. Here's a look at Asian markets as they stand at the moment. They're on the stage on the left. In fact, you see the leaders of Japan's major political parties among them in the blue. Tsunai Takaichi ahead of the February 8 election, of course. But we've got a bit of weakness in Japanese stocks at the moment, off by about 1.75%, perhaps to be expected considering the big move we saw in the yen. 154.21. This is after the New York Fed called asking for currency checks, which did suggest the US and Japan are preparing to move in concert to defend the yen. So that has created a somewhat risk-off environment for Japanese equities. It's risk-off for most of the equity markets. The Kospi a bit softer as well. Tell you what's rising, though, oil and also gold punching through that $5,000 an ounce barrier and showing no signs of slowing down. Well, investors are on high alert for mounting risks in the markets, and that includes another escalation in US-China tensions. Traders last week put on hedges on a series of US ETFs tracking Chinese assets, with the market facing pressure from both trade ructions and disappointing tech earnings. For more, let's get to our Asia equities reporter, Winnie Su. So, Winnie, China's two-speed economy has been driving its stock markets. Tell us more about that.
Yeah, so it is quite interesting as we saw a series of reports coming out last week after that set of eco data on Monday showing a divergence in Chinese economy. On one hand, you have very strong numbers when it comes to the industrial outputs and also exports. But on the other side, you have still very weak domestic demand. And we're hearing from BNP Paribas, for example, saying that investors now really have to navigate that two China stories, right? How do you position your stock picks according to this, and hence they're preferring sectors like industrials, materials, for example, and also IT that would actually benefit from these exports. And that's a similar story that we're hearing from, for example, JP Morgan Asset Management, saying that they are actually also betting on this going global story when it comes to Chinese stocks. So it's quite interesting to see how that's really playing out in investors being more selective with Chinese equities.
Well, China's national team, meanwhile, seems to be taking a step back. What's going on there?
Yeah, so we are talking, for example, today you can actually see that Chinese stocks pairing a bit of gains from earlier, and that is also partly driven by how national team is taking a step back. So yes, we are talking about, like you mentioned, traders putting a bit more puts on Chinese large caps and also internet names because of these political risks, right? Because last week you've got China actually criticizing the U.S. over its trade deals with Taiwan, saying that this is draining Taiwan's economy and a way for the Trump administration to contain China. And then with that, you've also got these cooling measures from regulators to come or to engineer that slow bull run. So you mentioned that big outflow from national team. But beyond that, we've also got regulators recently tightening the rules when it comes to margin trading, and also them clamping down on these high-frequency tradings. And just last Friday, you've also got them saying that they are tightening the rules when it comes to mainland companies trading in Hong Kong.
All right, Bloomberg's Asia equities reporter Winnie Su there. Well, the Goldman Sachs Global Macro Conference gets underway in Hong Kong tomorrow. Its co-head of Global Private Wealth Management, Meena Flynn, manages $1.9 trillion for the firm's ultra-high net worth franchise. She spoke with us earlier on the main question she's expected to get from private wealth clients at the event.
Valuation matters, and when you're starting at a high place, you have to have a much greater probability that you're going to get a drawdown. We think that there's an 80% probability we're going to get a 10% drawdown. We want to be able to react to that opportunistically. But it's not the main driver of forward equity returns. The main driver of forward equity returns is S&P earnings growth.
So how important is it then to go beyond the Mag 7 and see a broadening out, and the broadening out of those profitability as well?
The Mag 7 are doing fine, right? They've still got earnings growth that is 20% plus. They've got ROEs of 60%. So they're able to heavily invest in their business, protect their moats. They've got the scale to continue to reinvest. That being said, what you're getting from the other 493 is a significant pickup in earnings, almost a double of earnings this year to go from 7% to 12%. So what we are expecting is that you will get more of that broadening out, whether that's coming from very healthy consumers, corporate balance sheets, some of the items out of the One Big Beautiful Bill that are going to really keep propelling the spending.
Where are your efforts focused on for those family offices? Because we're also right now in a generational shift, whether it's first to second or second to third. Maybe the new generation have different risk profiles.
Yes. So to your point, we are in the middle of a significant wealth transfer. And what that looks like within families right now is that the wealth is first transitioning horizontally, usually from patriarch to matriarch, given the different lifespans, and then second to the adult children. Many times when the primary decision maker from a financial perspective changes, their goals, their objectives, their risk tolerances change. And so we are seeing more interest in alternative investments as well as thematic investing. So what are the structural themes that are really going to outperform over the next 5-10 years? So whether that's robotics, cyber, defense, healthcare innovation, of course AI. So we make sure our clients have exposure to trends like that. And then these clients are also looking for a more digital and seamless approach, and one that's really coordinated across their advisors, whether that be tax, legal, investment advisor, and we look to play that quarterback role for them.
I did see an October survey of your clients found that 58% of the family offices expect to be overweight portfolios to tech in the next 12 months. Given what you just said, 58%, is that under expectations, or is that about what you would expect given the returns we've seen in the AI space?
Yeah, so the beautiful thing is that we have in our clients' portfolios roughly about 70% of an allocation to risk assets. Yeah. Within those risk assets, 25% is to private investments. A lot of the exposure that our clients has, whether that's to technology or other high growth opportunities, comes in those private areas.
How about alternatives? Gold, spot gold just hit $5,000 $1,000 an ounce right now. Gold, crypto, we can touch on a number of different ones.
Yes, and so gold and to some degree crypto is something that our clients look to more as a safe haven from a political disruption perspective, or to the extent that they're worried about a dollar debasement. Gold really is benefiting from the fact that central banks are starting to diversify their reserves, as well as that the Fed has been cutting interest rates, so the opportunity cost of holding gold is not as significant as it once was.
That's Goldman Sachs co-head of global private wealth management, Meena Flynn, there, speaking with Bloomberg's Stephen Engel. And Bloomberg will be live at the Goldman Sachs Global Macro Conference in Hong Kong tomorrow. You can tune into our exclusive interview with the bank's CEO, David Solomon, and it's happening at these times on your screen. Well, let's get more with markets now. Aoifinn Devitt, Senior Investment Advisor and Global Market Strategist at Moneta, joins us now. Aoifinn, thanks so much for your time. And I just want to start by picking up on the remarks from that interview there and ask you how your risk appetite is at the moment.
That was a very interesting interview, and we would actually align with a lot of those views, particularly when it comes to family office orientation as well as risk appetite. I'd say our risk appetite at Moneta is pretty consistent in terms of we do share the optimism regarding the U.S. economy. We also build in resilience. Our goal is not necessarily to predict the direction of markets and portfolios, it is to prepare. And the resilience we've built in is around inflation protection, because inflation is still there, even if it's coming down from a headline level, as well as around those kind of market issues and market corrections that we need those portfolios to be all weather and resilient towards them. So that's where our diversification comes in.
So can you tell us a little bit more about what inflation protection looks like to you? I mean, are you catching this wave in gold at the moment, or are you going elsewhere? And do you prefer US or Asian assets right now?
We have always factored in inflation protection organically, so in the actual assets themselves. So that's to say, with real assets, we would have some exposure to real estate as well as energy, real assets, infrastructure, anything that throws off a contractual yield, which is in some way inflation linked. So that's where those leases come in, as well as most inflation cash flows. We see equities as a pretty organic exposure to inflation that naturally will track inflation. Fixed income bonds will be the opposite. So generally, we build them in. Do we look at gold directly? Generally, we prefer to see gold and precious metals as part of an overall portfolio allocation. We prefer to see it not through the metals themselves, but through a substitute for that or through an ETF, and generally much more integrated within the portfolio, simply because of the volatility inherent in something like gold or silver. We don't believe that many clients are willing to tolerate an exposure where there could be a 10% fall in one day. We saw that particularly in silver around the end of the year. But we do see that exposure not only to the precious metals and inflation, but also to what your previously guest said, currency debasement. And really, we see it also as a risk of government's fiscal policies getting out of control. And we think we did see something like that with respect to the sell-off in Japanese debt last week.
Yeah, let's talk a little bit more about the situation in Japan. Do you think we're going to see some U.S. Japan coordination when it comes to defending the yen? Because certainly just the suggestion of that seems to be enough to send the yen strengthening.
That was a fascinating observation just in the last few days. That's just stepping back in terms of what was going on in Japan. We know that Secretary Bessent did suggest that was why U.S. equity markets were correcting or faltering last week, was because of the specter of a sell-off in Japanese government debt. What we saw that was as maybe a canary in the coal mine, similar to the Liz Truss moment that we saw in the UK in the end of 2022. When there is a crisis of confidence and a flight from a government's bonds, and that's when you can really point to greater, perhaps, concern around fiscal policy and whether it's matching the monetary policy in place in the country at that time. So we do think that there is a very much a warning sign coming out of Japan for other markets, that markets can tolerate the rise of fiscal debt for so long, but not forever. So in terms of the coordination, it's very interesting to watch. We know that there is certainly a desire for intervention at all times, and that's sort of a backstop that we have on markets, but we are watching that very closely.
Do you anticipate that we might see some price action like that again? And if you do you have any ideas on the timeline of that? And if it does happen again, what could the contagion risk be, and what might it mean for rates in other countries?
Yes. Watch the price action. I'd say let's backing up a little bit. The impact of Japan on our average investor portfolios is not going to be very high. Our investors tend to have a U.S. dominant portfolio in their equities. They would also have a small amount in non-U.S. equities, a small amount in emerging markets, but it has never been the size you would see in an institutional portfolio. So we may look at Japan in terms of an interesting macro story, and as I said, a canary in the coal mine for elsewhere, but it's not going to have a major impact on how a portfolio is driven. So in terms of an intervention, we do think that there is certainly coordination, that the trade war, the global trade policy is very much on the minds of leaders around the world. Just coming out of Davos, there has been this desire to crank out deals, to make things commercial, to return to capitalism in its older form, perhaps. And so intervention could well be on the table again.
You were talking a little bit earlier about hedges against an inflation environment, and we just touched on political risk there as well. And I'm wondering, in that regard, how does China look to you as a hedge against the current uncertain backdrop? Because at the moment it's looking, relatively speaking, like a beacon of stability and sanity.
That is a fascinating story. What we've been observing in China is a real round trip in terms of investor sentiment. We know that China was hugely popular. It moved to being perceived as uninvestable or higher risk. There was a flight out of China from U.S. investors in particular, but generally there was a desire to have emerging market ex-China. And now we've seen China rise again quite impressively over the course of 2025, and it has become an alternative technology play. So it is basically, I think, quite correlated with the U.S. technology play. So will there be diversification built into that? Not as much as it looks is the answer. Even though we know that Chinese markets have outperformed over 2025, we do see that if there is any kind of correction in technology, we've been speaking less about the AI bubble popping, maybe because other headlines have dominated. But remember, that was, at the end of 2025, quite a high risk. So if that were to pop or to deflate in some way, we believe that China will be dragged down with that, so that there would be correlation, less diversification. But definitely in terms of spreading risk, we think it's a very interesting play right now.
You've mentioned elsewhere the need for a regime adaptive portfolio. Is that an example of what you're talking about, or can you tell us a little bit more about what you mean?
Yeah, that's a concept that really aligns with our all-weather approach. So we know that there in the past there would have been maybe a regime in place that was in place for decades. Now we're at a sort of regime change. We know that there is a deglobalization impulse. I've spoken before about the realignment of the geopolitics. And what we need is a portfolio that is not necessarily only going to be performing in an environment where perhaps equity markets go up. We need a portfolio that is flexible and able to adapt. That's where the diversification is built in. Your previous guest spoke about the tendency of family offices to do more in alternatives. We very much have used alternatives for years. Alternatives are where you get that flex, that point at the end where there will be perhaps an adaptation to macro change that usually comes through hedge funds. We tend to use that through a more diversified basket of alternatives, including hedge funds, private equity, private credit, areas that can, because of their liquidity terms, not necessarily move in sync. So that is really the regime adaptive. And equally, having global exposure allows exposure to different regimes as they evolve.
As you're speaking there, we're seeing a chart of the US dollar, which has had a pretty wretched time of it recently. I'm just wondering what your long-term view is on dollar strength. Do you see more weakness ahead? And even bigger picture, I mean, no global reserve currency lasts forever. Are we perhaps seeing a bigger shift going on?
With our clients, we've had constant conversations around dollar debasement. They come and go, I suppose, ebb and flow based on sentiment around how the US is perceived. And we certainly, with the recent rise in gold and some of the concern around the geopolitical situation of the US, and we know that the dollar has been weaker, and certainly with the Trump administration's policies, that's in their favor to a degree. It boosts exports, US exports, and there isn't a particular concern that they're actually quite happy to have it low for the moment. In terms of investors, of course, that's a different story. This is exactly why the non-US equity exposure is so critical. Having the strength of the dollar for as long as they did, that made the non-US equity exposure to have really a double whammy when it underperformed. Now that there is this weakness in the dollar, it's critical to have exposure to other currencies. Will this be the currency of last resort going forward? For some time, yes, but with the encroachment of digital currency, as well as the strength of gold, we do think that there is going to be this sustained weakness, although some flattening from here. We don't see it going much lower, but we don't see anything that would cause it to strengthen either.
All right, Aoifinn Devitt, Senior Investment Advisor and Global Market Strategist at Moneta. Thanks so much for joining us. Still to come, Chinese officials are said to have given the green light to the country's largest tech firms for their Nvidia H200 AI chips orders. We'll have details of that next. This is Bloomberg. Welcome back. You're watching Insight. Bloomberg has learned that Chinese officials are telling Alibaba and its peers to ready orders for Nvidia's H200 chips. And this suggests Beijing is close to formally approving imports of the products essential to powering AI. For more, let's get to our Asia Tech correspondent, Annabelle Drewlers. So, Belle, what else are we hearing from sources?
Yeah, well, this has really been one of the big question marks, because after we had Washington saying that H200 chips could be exported to China, it was really down to Beijing then, would they approve them to be purchased by Chinese companies. But what we're hearing from sources is that Alibaba, Tencent and ByteDance have been given the green light essentially to move forward in the next stage of preparations to buy the H200 chips. So now they're at the point where we understand these companies can discuss the specifics of exactly how many units they'd be looking at purchasing. So I guess an in-principle approval at this point. Now, it doesn't mean that the big tech companies in China can turn their back on Chinese semis. Of course, we've just really seen lots of different Chinese semi names like Huang or SMIC, Huawei, more threads, many of those that are really filling in or rushing to fill the gap that was left by Nvidia that's been locked out for a couple of years. But what we do understand is that China will also expect these names or these companies like Alibaba, Tencent, ByteDance to continue purchasing some homegrown semiconductors, so we don't know the exact quantities on that just yet. If it does go ahead, it's of course a big win for Nvidia, and we've seen Nvidia, for instance, in the session today, you've got the Chinese chip names under pressure, but Nvidia rose on Wall Street overnight and end of the day, or end of last week, but end of the day higher essentially. TSMC ADRs as well, they were higher. They are a bit under pressure in the session today, but we do know that Nvidia said that they haven't spoken with any of these companies directly, but we have been reporting at Bloomberg that Alibaba and ByteDance could be looking at 200,000 semiconductors each. In terms of the timing on that front, as what we've heard, it could come maybe as soon as this quarter.
Well, we're also coming to another pivotal earnings season for big tech. What are you going to be watching in particular?
Yeah, this is going to be a really interesting earnings season. So lots of different companies, but just this week alone, we've got Microsoft, Meta, Tesla coming up first. Then we've got Apple on Thursday as well. Next week we go into Alphabet and Amazon, and then we finish out February. Nvidia, you can see there, February 25. So across the course of the end of January into February, it's going to be a really important litmus test, because if you think about where we were going into the end of last year, it was all these concerns around the amount of spending on AI. Were we getting enough ROI? Were there too many so-called circular deals in the market? So now we've got this big sort of test of that as well, because we have seen generally Mag 7 stocks a bit under pressure, even though they've been recovering of late. But essentially, the expectation from our Bloomberg intelligence team is that we're going to see a 20% revenue growth for the fourth quarter, rather. That's across the board. In terms of the specific companies, I think Microsoft is going to be quite interesting again up first, but it'll be a good early test given they're operating Azure, of course, and very big numbers coming in on the cloud revenue side. That's still expected to grow around 36%. In the latest reporting period, it was up 40%. But again, it also comes back down to that CapEx, because CapEx across Mag 7 is expected to come in around $475 billion in 2026. That'd be a big jump from where we were in 2025. So again, back to that ROI theme, and are we actually seeing really investors getting payback and companies getting payback from the amount of money that they're spending?
All right, Asia Tech correspondent Annabelle Jewellers there in Hong Kong. Still to come, we're going to discuss Blackstone's private wealth business next at the Asian Financial Forum in Hong Kong. Its head of APAC joins us exclusively for his first TV interview. This is Bloomberg. Welcome back. You're watching Insight. So let's take a look at Asian markets. Seeing a little bit of ground being lost against some of the equity space. The Kospi a bit weaker, the Nikkei weaker as well. Gold just continues to accelerate, 5,072 an ounce now. It's actually this century. It's now outstripped the S&P in terms of returns, 1,600% in 25 years. Now, the yen also weighing on Japanese equities, 153.96, continuing to strengthen, and this is after we heard the New York Fed had asked for a currency check on the yen, which suggests the possibility of coordinated intervention between Japan and the US. So let's dig a bit deeper into the yen's moves now with our chief Asia FX and rate strategist, Stephen Chu. So, Stephen, it's been a long time since we've seen this kind of coordinated action. Potentially, if Japan and the US were to act in concert, what sort of influence could they have on FX?
I mean, it depends. We'll see whether they really intervene, whether from the U.S. side or the Japanese side. But at least for now, market is really shocked and now very vigilant. I don't think they would go back to short the yen, at least for this week. They will see what's going to happen, whether the Japanese, they're going to act to their words. It's very interesting. If you look back at the Japan intervention history, usually the very last step before they step in is the rate check. So even if the rate check news came from the Japanese side, the market would have reacted a similar way. But now it's from the New York Fed, as you said. So that's a larger thing. Now market it's now romancing a coordinated intervention between U.S. and Japan. So which is why it kept the yen strengthened even earlier this morning. No real action still, but the yen just continued to be supportive for now.
There's always questions over the effectiveness of intervention and the duration of it as well. Should this happen, where would the floor be for the yen under any scenario you care to consider?
Yeah, I'll give you the floor first. From a fair value perspective, if you look at the 2-year and 10-year U.S.-Japanese yield gap, it's pointing to a range of 120 to 130, so a lot lower from the current level. If we use our in-house BI model, it's pointing to a fair value of near 129. Again, a lot lower compared to the current level. So there's still a lot of headroom from here. Of course, talking about effectiveness depends on the U.S. dollar side as well. If the dollar weakness continues, whatever the U.S. does, whether it's geopolitics or the Fed, then that will give the yen a boost as well. So it depends on the dollar as well, whether it can last.
All right, Bloomberg Chief Asia FX and rates strategist Stephen Chu there. Let's get back now to the annual Asian Financial Forum in Hong Kong. The China show co-anchors David and Glaze and Yvonne Mann standing by with our next guest.
Yeah, just given what we just saw, the volatility around public markets, I think at the start of the year, there certainly is a discussion here on what the outlook for private markets are going to look like here. Yeah. And really here to join us now is Ed Huang. Talk us through his outlook. He's the head of APAC at Blackstone Private Wealth. Ed, it's good to have you here on the program. Your AUM has just, continued to have exponential growth here. I believe it's tripled in the last few years or so. Tell us a bit more about, where you are. Where are we in this whole private markets discussion? Are we just early innings? Where are we?
Well, thank you, Yvonne and David, for having me. It's a pleasure to be here. I think we definitely are in the early innings for private markets, particularly here in Asia. Right, as I take a step back and look at our business, we've grown tremendously over the last couple of years. Right, our team size has basically doubled over the last 2 years, and we've been expanding our footprint. We now work with over 40 private banks and wealth managers across the region. We've been expanding our team. So outside of Hong Kong and Singapore, where we've had team on the ground for many years, we're also expanding in Japan, Australia, China, as well as Korea, which we just entered last year. Japan actually has our largest team on the ground, and we see an immense opportunity there. And overall, we think there's a massive opportunity ahead that we're scaling for. Right. So as I look at the outlook and sort of the prospects for private markets in the region, I think obviously there's a massive opportunity opportunity. And I think that's driven by a few factors. I think, one, there's been significant wealth creation in Asia. As we look at this, we think there's $80 trillion of wealth sitting within private wealth globally. Roughly a third of that sits in Asia, and we expect that to continue to grow. And also, we think investors here and families here are going to be looking to preserve and to grow their wealth. At the same time, adoption of private market products is incredibly low. If you think about it, institutions are roughly 30% allocated or more to private market products. Meanwhile, individual investors are approximately 3% allocated to private market products. And I think in Asia, in many markets, it's much, much lower than that. So obviously, there's huge room for growth. I think the current market backdrop actually highlights the case for private market products. Right, you have more volatility in the market. The public markets are more concentrated. And overall, if you look at 60-40 portfolios, they don't have, the same diversification benefits as they've had in the past. Right? If you look back to 2022, over 70% of the time, stocks and bonds have been correlated. So overall, if you look at private market products and where they fit in investor portfolios, I think the benefits are actually quite significant. Right? They have outperformed public benchmarks over time. They improve diversification. They reduce volatility for investors. And if you're looking to build financial security and build wealth for the long term, we think private market products will be a very, very important third leg to investor portfolios. And we are seeing significant interest among Asian investors across a number of different markets, for private market strategies. So yes, we are in the very, very early innings.
I mean, keeping up with demand, the way you describe it, almost from a low base, but the delta is so quick and this refreshed recognition of what private markets offer. I mean, it's a good problem to have, right?
Yes.
You mentioned Japan. Japan specifically, why? What's with that market, and why do you think there's such a long runway there?
Well, Japan is very, very exciting for us. It's already the second largest market for us for private wealth outside the United States, and we think it has an opportunity to grow much, much bigger. Right? If you look at the overall context of the market, why is it so compelling? I think, first of all, there's a policy initiative. There's an initiative, for the country to move households from savings to investment. If you think about it, there's $15 trillion worth, roughly, of financial assets held by households in Japan. Roughly half of that sits in low-yielding cash and deposits. And at the same time, Japan is positioning itself to become a leading asset management center across Asia. So you've seen essentially an enablement of more high-quality products, investment products, to be available to Japanese investors. So I think overall there's a huge opportunity for us, and Japanese investors are just starting to get to know private market products, right? And so again, we've been building a team on the ground. We're working with leading financial institutions on the ground. Yeah. And just last year, we actually were the first alts manager to launch a major ad campaign in Japan. We think it's really important to build our brand in the market. We actually are the first to bring 4 flagship strategies into the market across private equity, private credit, real estate, and infrastructure. Yeah. And we think it's important to sort of build on the long history that we've had with Japan. Actually, a lot of people don't know that Japan is quite fundamental to Blackstone. Actually, one of the very first investors in one of our first funds was a Japanese investor, Nikko. So our founder and chairman, Steve Schwarzman, likes to say that without Japan, there would be no Blackstone. So that's an important history for us to build upon. We also want an opportunity to engage and interact, with Japanese investors, help them understand how we invest, who we are, and so we think there's a long road ahead.
What are sort of the strategies that you're looking at for 2026 now? Is it still private equity or private credit? I mean, it certainly has gotten a lot of spotlight, but what do you think are some of the strategies that are going to work the most this year?
Yeah, well, there's a number of strategies that we think, are well positioned for 2026. I think, first of all, for private equity, we think it's a very interesting opportunity. Overall, the economic environment looks resilient, and rates are coming down, and we see deal activity picking up, which will be great for private equity, right? So, again, we've been very active in deployment. And, we're seeing more and more monetizations, IPOs, realization events, right? And so we think it's a great time, and the outlook for private equity is strong. And we're focused around a few big themes out there. AI is the main thing, but energy as well, life sciences. So there's a number of themes that we think are quite important within private equity. And we're seeing quite a bit of interest from investors in our private equity strategies across Asia. We think private credit last year We had an incredible fundraising year in Asia for private credit. We continue to see this as a durable asset class. It delivers excess premium versus liquid credit with not taking on an additional amount of risk.
Right.
So we continue to see this as a compelling asset class. And we think, it's a really interesting opportunity, for real estate ahead. We've been very active in deploying in real estate over the last 12 to 24 months. And if you look at real estate values on a relative basis, real estate values are up about 6 to 7% up from the trough. Meanwhile, if you look at the S&P 500, it's at all-time highs. It's up 100%. Bonds are near all-time highs. So again, we think on a relative basis, with rates coming down, that actually it's a very good time to be thinking about real estate as an asset class, and we hope to see more activity here.
What are you seeing as far as, deal size, ticket size is concerned? Because of players like yourself, companies now can frankly afford not to go public. They have access to debt and equity in larger and larger portions to stay private as long as they want to, I guess. But I wonder what that's doing to valuations and ticket sizes.
Well, in general, for us, we are focused on larger scale transactions. And I think you're right. Companies are saying private for longer, right? The private markets are much bigger. And I think, again, it's a much larger pool of opportunities. If you think about it, the public markets today have fewer, have fewer companies than it has in the past, right? There's roughly half the number of public companies today versus 30 years ago. Meanwhile, if you look across scaled businesses and real estate assets, roughly 90%, of these assets are private, right? And so investing in private markets enables investors to access a much larger pool of opportunities, as well as access, a manager like ourselves, our deal origination capabilities, our value creation capabilities, and that's why we've been able to deliver outperformance over time across cycles.
What do you think are still some of the risks that maybe investors don't know about, particularly private credit, right? It's still quite opaque in terms of transparency and the like. If there are any risks, what do you think they are?
Well, overall, as we look at private credit, we don't see the same picture that some of the media headlines that we're seeing, right? I think as we look at the overall environment for private credit, it still looks quite compelling. Okay. It's a durable asset class. We see a resilient economy. Market defaults are down, and as we look at our own portfolio, we think portfolio quality is quite robust, and we're seeing EBITDA growth in our portfolio. So again, I think the idea for private credit is it brings investors right up to the borrower, right? And so we cut out the middlemen in the middle. It provides borrowers with better speed, more certainty, more flexibility, which is great for borrowers, and it allows investors to keep more of the return. And again, they're getting that excess return without taking on a lot more risk, right? And so, again, we think there's actually a lot of room to grow still in private credit. We think it's actually an important asset class, particularly for investors that are looking for yield and income. And so, again, we're positive on the outlook for private credit.
I don't know if we could still call it the dawn of AI, because it feels like we've been talking about this for more than we actually have. But how has that changed sort of just deal origination for you guys as far as real estate, for example, keeps coming up, data centers, and you got to wonder whether the headline is leaning what's happening on the ground, or is it the other way? Are we in a bubble? What are you witnessing exactly as far as literally on the ground stuff is concerned?
Well, what I would say is, for us as a firm, we look at AI as an incredibly important theme. It's transformational, it's revolutionary. We call it the main thing. And we really are focused on the picks and shovels of AI. So we're looking along the whole value chain, and we're seeing where can we participate where there's interesting value. And I think, first of all, for data centers, if you look at the amount of data creation that there's been in the last couple of years and the amount going forward, together, with AI, with things like ChatGPT, with autonomous vehicles, the amount of data creation and compute needed, there's going to be a significant need, for data centers. And we are the largest owner of data centers in the world, and we have a very large pipeline ahead. And so we think that is a very important opportunity. And obviously, to power these data centers, we think there's an incredible opportunity in energy, right? And so, again, we're very focused on various areas along the value chain that essentially benefits from the large opportunity ahead of us for AI, but we think it'll impact, all of us in how we work and in all of our businesses. And if you look across our businesses, everyone is focused on making AI investments and seeing how to take advantage of this opportunity.
I hear that you're also expanding your team as well. In terms of headcount, are you looking to add more this year?
I think definitely. Again, as I mentioned, we've roughly doubled our team size over the last 2 years. We're certainly continuing to grow our business. We want to expand in Japan. We've added people on the ground in Australia. We're putting people on the ground in Korea. So we are looking to continue to scale up our team to meet the opportunity.
Is there a number in mind that you have for Japan?
Well, again, I think there's a significant growth path we have ahead of us, so we're going to continue to invest in our growth.
All right.
Ed, we're going to leave it there, but thank you so much.
Thank you.
Ed Huang there from Blackstone Private Wealth.
Thank you.
Joining us here at the Asian Financial Forum. Paul, we'll send it back to you.
All right, thanks very much. That's China Show co-anchors David and Glaze and Yvonne Mann there with Ed Huang. All right, let's take a look at some breaking news we're getting about SoftBank, said to have halted talks to buy the data center firm Switch. We got this news a short time ago. It says Switch and SoftBank are exploring other partnerships in U.S. data centers, and it scrapped plans to announce the Switch buyout earlier this month. So SoftBank said to now be halting talks to buy the U.S. data center firm Switch. We're seeing a little bit of weakness there in SoftBank shares, but we're seeing a little bit of weakness everywhere in Japanese equities at the moment. Still to come, the so-called mother of all deals is in the making as EU leaders arrive in India for trade talks. We'll have details next. This is Bloomberg. Watching Insight. We've got some live pictures for you now of India's Republic Day Parade, the 77th Republic Day Parade. It is, of course, a public holiday in India today to celebrate the country's founding. There you see on the right of your screen EU Commission President Ursula von der Leyen. Also joining her is going to be European Council President Antonio Luis Santos da Costa as well. The EU in town to advance negotiations on a trade deal between the EU and India, often referred to as the mother of all deals. We've had a few developments on that front as well, with India's federal cabinet approving some parts of proposed agreement relating to defence sections in the EU, also some agreement around vehicle imports into India as well. So with more on this, let's get to Bloomberg South Asia political reporter Swati Gupta joining us now. So Swati, India is going to be cutting tariffs on EU car imports. Do we know any more details about this, and what else is going to be negotiated tomorrow?
Hi. The deal has been decades in the making, and both sides are extremely optimistic that this is going to help them in countering the tariffs that are coming from the U.S. But we are expecting the deal to have significant impact on lowering import duties, especially for defense, security, industrial goods, and a range of consumer products that are exchanged between the two countries. The two countries have agreed to open market access for select agriculture goods, not all of them, and discussions have been underway on steel and automobiles, but we are starting to hear from officials that those discussions are also getting concluded as they head into the summit talks tomorrow.
So what are some of the benefits of this tie-up going to be for both India and the EU?
I think a lot of it is about countering the tariffs that are coming from the U.S. Both sides require some stability when it comes to export and import. And the EU is hoping that to some extent that they get access to Indian markets at a low cost, which has been unavailable before. But they are also pretty sure that they don't want certain sections on both sides to be opened up. So India doesn't want to open their agriculture completely. And those are the things that we are going to be watching out for tomorrow as the announcement comes.
Well, you say this has been decades in the making, and it has. Are we setting up for a similar long, torturous process when it comes to progress on an India-US deal? Because it seems as if very little is happening on that front. Can you give us any updates?
Yeah, things have kind of stalled now, right now, between the India-US deal, and Indian officials held meetings last year in December, and we are still waiting to see where it goes. In the meantime, India is focusing on diversifying. India has quickly been signing trade deals. They did one with the UK. They finalized one with New Zealand and Oman late last year. And the EU deal would be significant because trade with the EU makes up about 17% of India's total exports. And economists are predicting that that number is also going to rise once this trade deal is signed. So it is significant that India is doing this, as well as the European Union is keen to do it. But there are no real updates from the US on where the deal is at this point.
All right, Bloomberg South Asia political reporter Swati Gupta there. In other news, natural gas futures are in focus as freezing weather sweeps through large parts of the US. The storm is estimated to have knocked offline almost 10% of America's natural gas production, just as demand jumps. Let's get to Bloomberg reporter Dan Murtaugh here. So, Dan, can you give us a sense of the situation in the US at the moment and what's happening with natural gas prices?
Yeah, the Arctic blast that's hitting the U.S. affects natural gas in two ways. As you said, it cuts off supply. Basically what happens is it freezes up equipment at wells, pipelines, processing facilities, forcing more than 10% of U.S. supply to be shut in. And then on the other hand, you have heating demand, you have power plant demand that's surging, and that's pulling more demand on it. And so incredibly, we just saw Texas, down in the deep south of the U.S., one of the hottest parts of the country, they're projecting record power demand tomorrow, even higher than in the dead of summer when all the air conditioners are on, because of all this extra winter demand. So you have less supply, more demand. That's going to push prices up.
So, Dan, how is this affecting traders who are betting on prices falling?
Yeah, this is coming at a really, really tough time for traders. We're sort of toward the end of winter, and it's been a pretty mild winter in most parts of the world. And so people were seeing like stockpiles relatively flush. They started betting on prices going down. You saw in the CFTC Commitments of Traders report, lots of hedge funds were betting on prices falling. And so this real big blast coming in, putting a squeeze on prices, is really catching a lot of people up. That's why, especially in the U.S. market, you saw prices surge. They almost doubled since January 16th, 10 days ago. And that's because of a lot of short squeezing on people who were betting on a decline.
So what's the outlook for prices, and can we expect to see more volatility?
I think the gas market, you're going to see a little bit more volatility in the U.S. in general, just because we're exporting more gas through LNG. The storage hasn't really increased. So we have all this extra demand and extra supply, but not a whole lot of extra balancing in the storage. But the interesting thing now to watch is, whether these U.S. price rises sort of percolate throughout the rest of the world. Now that the U.S. is the world's largest LNG exporter, any moves there can affect supplies to Europe, to Asia, and have, price impacts as far away as Germany, Japan, and China. Right now, it's looking like this is going to be a short-term event. So by next week, this should sort of ease off a little bit. But as the U.S. becomes more and more important to the global gas world, things like this are going to become more in focus for traders everywhere.
All right, Bloomberg reporter Dan Murtaugh there. Let's get back to these live pictures from India. It's a public holiday in India. The country's celebrating Republic Day. This is 77 years since the adoption of India's constitution. In attendance, officials from the EU, including Ursula von der Leyen, because, of course, tomorrow, there you see Prime Minister Narendra Modi. Tomorrow there will be more talks between the EU and India on advancing a trade deal. That is it, though, for Insight. Horizons Middle East and Africa up next. This is Bloomberg.